Hi, I'm Josh Young with Bison Interests, and this is our perspective on the natural gas boom in the US. Please see this important disclaimer. So, just some background on Bison. Um, we've uh, we've done quite well since we launched in May of 2015, particularly compared to the index that we're most often compared to, which is the S&P 600 Energy Index, which is composed of smaller cap publicly traded oil and gas companies, which is the area that we are focused on. And we think that's relevant for our analysis of this very interesting set of opportunities that we're finding in the natural gas space, particularly in the US. So we're going to walk through what we're seeing in the natural gas market right now, what we see going forward over the next few years, and where we're finding some of the most compelling opportunities. So when you think about sort of what's going on in the natural gas market right now, probably the two most important things are that production and demand have grown tremendously over the past decade and are forecast in the consensus to grow quite a bit over the next decade from a demand perspective. But from a supply perspective, we've seen supply flatten out over the past year, and we've seen the rig count fall quite a bit, which we'll show in another slide. As, as this has happened, we ended up with a temporary glut in the natural gas market over the past couple of years, which led to record low prices and builds in natural gas inventories. And this temporary build in inventories and temporary period of low prices set the market up for what we're seeing as a tremendous boom going forward. When you think about cyclicals, both from a stock perspective and from the underlying commodity or sort of other cyclical perspective, you can think about things from a sort of four quadrant type process. We got this graph, I think, from Goldman, but a number of different banks and firms have sort of shown this sort of quadrant style approach to cyclicals. And when you think about it, rising prices lead to more investment and high returns on invested capital, which lead to a period of high prices and overinvestment, which ultimately leads to a glut and falling prices and reduced investment, and then ultimately to a period of low prices, low investment, and potentially falling or less rapidly rising production. We're emerging from this period of low prices into a period of rising prices. We found that that's been one of the most compelling points in a cyclical, I guess, in a cycle to capture upside opportunities in cyclicals. And what we're finding is that some of the larger caps exposed to this theme have already seen significant stock price appreciation, and some larger transactions have reflected sort of higher valuations, while at the same time, smaller companies on the public side and smaller assets haven't yet reflected this improved environment. And that is somewhat typical for this rising prices type environment. And we find that to be particularly compelling, especially considering what we're seeing from a broader gas macro perspective. So looking ahead, we think the single biggest factor in the natural gas market right now is incremental demand from liquefied natural gas export facilities and the very, very wide arbitrage right now between the local price for natural gas in the US and the local price and the sort of realized landed price for natural gas in Europe and in Asia. And even though there's been a surge in export capacity and export activity in the US, right now we're at an all-time high so far for LNG exports in the US and all-time global highs for liquefied natural gas, we're still seeing this very, very wide arbitrage as incremental gas is rapidly rapidly consumed and rapidly absorbed, and we're seeing more and more import facility construction announcements and the potential to absorb even more gas than this is showing. So when you think about the case for natural gas here, this base case that we're showing of potentially 24 BCF per day of demand growth by 2030, which we referenced in that prior slide showing the growth of supply and demand over the past decade and the sort of consensus demand growth through 2030, that's actually the base case in this chart, which gets absorbed through projects that are already announced, that have already reached final investment decision, that are either under construction right now or expected to go under construction and come online by 2030. The interesting thing when you look at it is that there are a number of projects that have been approved but have not yet received final investment decisions. So they have the regulatory approvals and permits and so on, but they're not yet funded and they're not yet under construction. And we think that a number of those facilities, considering the wide gap between prices in the US and prices in Europe and Asia and other import markets for natural gas, we think that those markets are signaling that there's robust demand, and we think that a number of these facilities will get built beyond sort of this base case. Even the base case is frankly supportive for higher natural gas prices, but the bullish case is extremely supportive, and we don't think that's sort of the market expectation or anywhere close to the market expectation. I'd say this is one of our big variant views on the natural gas market, and this drives our view that the forward curve may be mispriced and that prices may need to be quite a bit higher than the forward curve is showing for natural gas, which would be particularly beneficial to higher leverage companies in the natural gas space, reflected by sort of lower valuations, higher free cash flow yields, and so on. And so one of the, I think, big narratives that we see a lot in the media, and we'll take it if it works, but I'm not sure that we're quite so bullish on this, is the growth in demand for natural gas from AI data centers and similar build-outs. And so, there is a rush right now to build these very large, increasingly large data centers around the US and to a lesser extent around the world. And there is a growth in natural gas demand already from data centers that have already been built out. And we've seen chip purchases and various other things from NVIDIA and the like announced, and from some of the big technology companies that are planning on either building these themselves or contracting to having them built, and then using them for, contracting to use them for a long period of time. And so there is a lot of potential demand for natural gas from this. This is not really something we're depending on. We think there'll be a few BCF a day of incremental demand from this, but we've seen some estimates as high as sort of 9 or 10 BCF a day by the end of the decade, and we think that might be a little too aggressive. Again, we'll take it, that sort of right tail exposure for us relative to our view of the natural gas market. And so it's one of those things where it's very active and sort of front and center for most investors, and we'll take it, but we're not dependent on it. And so it's sort of nice to have this thing that we don't need that's going on that is absorbing additional natural gas both in the US and globally. And so it's just sort of an additional bullish factor for natural gas. So when we look at the supply demand picture, again, when we look out through 2030, the base case looks bullish. The high demand case from more LNG export facilities and to a lesser extent more AI data centers looks extremely bullish, and yet supply is not growing nearly as fast as it did historically, and the rig count is quite low. Again, when you look at how much gas needs to come onto the market versus what's happened with the rig count and with the natural gas frac spread count, it's pretty incredible. We just saw one of the large natural gas producers put out their report showing their Q4 production for 2024, which was down about 10% from their Q4 production for 2023. We saw a number of announcements talking about how they were going from running 5 rigs to running 7 rigs, and yet their forecast production for 2025, for Q4 of 2025, looks to be around the production level that they were at for Q4 2023. So even as we see this rig count ultimately go up a lot, there's a lot of damage that's been done from the rig count falling as much as it has, particularly on the dry gas side. And it's going to take a lot more rigs and probably a lot higher prices in order to deliver the supply that's going to be pulled from these LNG facilities, from the data centers, and from sort of standard economic growth driven demand growth for natural gas. So one of our other variant views is that we think that it's going to take a lot higher natural gas prices to get operators to accelerate development. And again, I did just mention an operator going from 5 rigs to 7, but it is noteworthy that in the process of going from 5 rigs to 7, they're just getting back to their production levels that they experienced a little over a year ago. And so to get these large operators to actually start growing materially in sort of the swing supply basin, which has been considered the Haynesville as a swing supply basin, the operators are saying you need $5 plus natural gas. We've spent some time speaking with former and current senior executives at a number of these different large dry gas producers in the Haynesville, as well as with producers in other major gas basins, either dry gas basins or associated gas basins, as well as with the service companies and so on. And I think that the message is pretty clear from the industry that current prices and even the current forward curve showing roughly $4 an MCF is insufficient to pull substantial incremental activity, and that $5 plus may be necessary in order to pull forward activity. Some of this is driven by inventory depletion, some of this is driven by cost inflation, and a lot of it's driven by the need to actually deliver economic returns, where a lot of the growth that we saw in shale gas over the past decade was actually uneconomic and didn't deliver a compelling full cycle return. The message from these companies and others is that they are looking for an attractive full cycle return, and that calls for a much higher natural gas price. I think there's a lot of warranted skepticism by industry observers and investors because of past misbehavior by E&P companies and others that have overinvested and sort of adopted the drill baby drill type mindset. And the good news is that with as low a rig count as we're starting with, it would take a lot of investment and likely a lot of time before that sort of mentality would deliver much higher production, which frankly is needed. And so far, we're not really seeing that mentality. Again, even among producers that are adding rigs, they're adding rigs to what looks like get back to prior production levels, not to grow substantially, despite what they might be saying. So when you think about it, you have this natural gas price curve and you have these variant views that we think are well substantiated between more LNG export facilities coming on, the speed up in the build of those LNG facilities by switching to modular, and the need for the large incremental producers that are sitting on some of the last remaining highly economic gas inventory for $5 plus natural gas per their statements and per our review of their inventory in the US. And then you look at the forward curve and see that it's not quite there at $5 yet, even for peak months looking out through 2029. And so you can see that there is this potential for much, much higher prices relative to this forward curve, and yet there are a number of gas producers that are trading at 20 to 40% type free cash flow yields if you get to that $5 plus type natural gas price environment, depending on the price of oil, the price of natural gas liquids, and various other factors. And so this is pretty interesting to us, and we thought it was worth doing one of these webinars and putting out a recording like this to be able to allow people to see it, just to see sort of how big of a mispricing there is, especially among some of these smaller producers that haven't yet traded up, like some of the larger dry gas producers that have captured a lot of the funds flow. When you look at the variant valuation between some of these small producers and some of the larger producers, and we showed an indicative basket of a few producers. The reality is that there's a number of smaller companies that are trading at quite large discounts versus these larger publicly traded company comps that we're showing. I think it's just worth thinking about for a second what it means when the trailing metrics for some of these smaller gas producers are lower than the forward metrics for some of the large producers. So it's essentially cheaper to buy some of these small producers on trailing metrics at a time where natural gas was near its decade low and be able to buy them for, let's say, 3 or 4 times trailing EBITDA and 20% plus free cash flow yields, versus some of these large producers where they traded at 10, 12, in some cases 14 times trailing EBITDA, and where on a forward basis they're still at 5 to 7 plus times EBITDA, versus the small companies at 2.7, 2.5, 3, somewhere sort of in that range. And so the valuations are way lower, and getting to buy companies cheaper on trailing metrics than their peers on forward metrics seems pretty compelling going into a potential substantial revaluation of the underlying commodities. Another way to look at it is dividends plus buybacks as a percent of enterprise value. And the set of companies that we're focused on for this achieved more than 20% buybacks plus dividends plus special dividends and so on. And you look at the peer set and you have 3%, 4%, 1%, 0% among these larger dry gas and liquids rich gas peers. It's pretty remarkable, and I think it's pretty exciting because if you think about what it means for a company to pay more than a 10% dividend or buy back and pay a dividend of more than 10% of their shares in a year, and then be able to do that again, and then have been able to do that at extremely low prices, in some cases not particularly supported by a substantial amount of hedging or anything like that. I think when you think about it, there's this real potential for these companies to sort of create their own returns and serve as their own catalyst just purely by returning this capital to their shareholders. And so there's a lot of upside, I think, in this smaller company set. The reason to not disclose these names is really it's not about the specific names of the companies as much as there being this tremendous opportunity to get leverage to this cycle and to capitalize on this upside from this very compelling bull market in natural gas. Secondarily, we think that the drilling rig companies should do quite well in this bull cycle. So we're seeing well productivity start to fall both for gas and for oil, and we're seeing the available rig fleet fall along with the active rig fleet, both for oil and gas. And the reason to mention oil here is just there are more active oil rigs in the US and in North America than gas rigs, so oil does play a component to this thesis. But when you look at the pure dynamic for these drilling rigs and what happens as you get higher natural gas prices, there is more of a call for these rigs both for dry gas, where we saw the rig count down for dry gas substantially, even more than for oil over the last couple of years on a percentage basis. And you see the economics improve for the liquids-rich gas wells and some of the oil wells that have a very high percent of their overall production coming from natural gas. And so there's sort of multiple ways that this rig market can improve. And this chart on the bottom right, this available and active rig chart is really exciting if you think about sort of what it means for this many rigs to go out of the fleet. And yeah, there have been rig efficiencies and there's various other stories around that. But the reality is that if you look at past down cycles for rigs, there were stories then too. And one of the best bets that I've found investing with a value tilt over the past decade plus is that when you invest in very heavily discounted stocks, when people are saying this time is different, it does seem to work out more often than not that this time is not in fact different, and those extreme levels of undervaluation reverse. And again, when you look at the well productivity per foot peaking out and starting to fall, I think it's very promising for the potential demand for more rigs. And it'll be interesting to see what happens when more rigs come on, because I think there's a good chance that you actually see well productivity per foot start to fall even more, and you start to see days drilling start to rise as some of the efficiencies that were gained by drilling in the core areas with core teams, essentially the very best people from each rig, as they're dropped, those very best people are retained and brought onto fewer rigs. And so you have sort of the triple A team, which ends up getting diluted a little bit as you bring on more rigs, and that could actually dramatically negatively affect rig efficiency as the rig count does start to rise. So one of the best plays that I've found historically has been to buy these rig companies and other sort of heavy equipment companies when people think that they're essentially going out of style or not going to be needed anymore, and they trade at a giant discount to their replacement cost. The particular company in this case that we're highlighting trading at roughly a sixth of its replacement cost, with 600% upside potential essentially to its replacement cost, versus actually generating positive free cash flow. Again, it's sort of this thing that shouldn't really exist. You should either in a cycle be able to buy equipment companies at a large discount, or asset intensive companies at a large discount to replacement cost, or at a high free cash flow yield, but not both. And when you look at this one, there's a high free cash flow yield and enormous upside to replacement cost. And so we are seeing that this particular stock is actually outperforming versus its peers. We think part of it is because there's a couple of billionaire large shareholders. One of them's the chairman, another runs a foreign equivalent of Berkshire Hathaway with phenomenal returns for decades. And they've both put more money into this company recently. But also we like this particular one because it's been paying off a lot of debt every year. And so as it pays off that debt, the value that it pays for that debt turns into essentially market cap. It's sort of the Miller-Modigliani theorem that this would happen with a lot of assumptions. And what we found over time is that companies that pay off debt like this, that start out over-levered and transition to under-levered or having no debt, that dollars spent on debt paydown can yield a market cap that's 2 times or 3 times the amount of money spent on debt paydown, due to lower risk, due to savings from reduced interest costs, and then ultimately because the shares respond even more favorably to ultimate dividends and share buybacks and similar. So we're really excited about this one. We think there's a lot of value potential for realization, and we also think that there's a whole set of these companies that are very inexpensively priced and have substantial upside. They just may not have quite as much upside from deleveraging, and also don't have the same sort of multiple billionaires and institutions backing them. It looks like trying pretty hard to put more money into this market cap that's quite small in US dollars. So we tried to show the process of unlocking value via debt paydown over a few years. And the thought again on this is, hey, this is what this looks like if the rig business stays pretty dead. with a very low dry gas rig count and a very low oil rig count after the active drilling rig fleet has been eviscerated and after day rates have come down quite a bit from their 2022 to 2023 highs. There's a lot more upside for this company, we think, and for the broader drilling rig subsector to the extent that we're right on our natural gas thesis. As more of these LNG facilities get built and as they get built faster, now that they're being built in a modular manner and being built in 30 months from FID to first gas instead of 5 years or 10 years like the current LNG Canada facility that's supposed to have been on years ago and hopefully is finally coming on soon. As there's this shift over to sort of more modular, almost an industrial revolution in LNG export facility construction and assembly, there's this potential for much higher rig rates and much more free cash flow for these drilling rig companies that are trading at such large discounts relative to their replacement costs. And so the nice thing in this case is that we have this company that's at this giant free cash flow yield to its market cap that's very rapidly paying off debt and potentially, per Miller Modigliani, set to deliver 20% plus type annual return just purely from debt pay down, and potentially a lot higher than that. And where there's a famous chairman who is actually chairman of a very large foreign E&P company, which trades at a large premium to this drilling rig company. We show these metrics on the top right. Again, the point of this isn't about the specific stock as much as there being these really interesting mispriced opportunities to get exposure to this really compelling bull market in natural gas here in the US. And so you look at this rig company versus the upstream E&P company. It trades at roughly half the enterprise value to EBITDA. It trades at a fraction of the price to book value, which is a nice proxy for replacement cost. It's not perfect, but it's a nice starting point for thinking about discount to replacement cost or premium to replacement cost. And it trades at an enormous free cash flow yield to the market cap versus this much larger E&P. Some of that is due to having a lot more debt versus the free cash flow and versus the EBITDA, but still being in a we think, very manageable debt situation, which you can see in the bottom chart should go from being perceived as somewhat over-levered currently to very modestly levered in a year or so, and essentially unlevered in a couple years or a few years, even in a situation, again, where natural gas prices stay muted. To the extent that natural gas plays out how we're seeing and the forward curve is too low and the rig count steps up quite a bit, both on the natural gas side and on the liquids rich drilling side, drilling for wells that produce a lot of associated gas, you could see this debt paydown move way faster, and you could see much, much more upside to levered equities like this drilling rig company benefiting from the coming boom in natural gas prices and natural gas drilling activity. So we got asked a lot, why is this happening? How could there be an opportunity like this? What's going on? And you can see the fund flows where the utilities have benefited the most so far in this natural gas bull market. We think mostly driven by the AI data center and energy demand boom narrative. And to a lesser extent, the larger cap dry gas producers in the basket that we showed previously have traded up quite a bit. The EQTs and Expands and Comstocks of the world have traded up a lot, but not nearly as much as the utilities. And then this basket of smaller caps that we selected is actually down a little bit over the past year, more in line with the sector outflows for energy, which showing this chart on the bottom right from Deutsche Bank shows that energy stocks have seen significant outflows while funds have been flowing aggressively into technology stocks. Ironically, these natural gas producers are supplying the gas that's needed for this latest growth narrative and latest growth wedge for the technology companies. So it seems to be a little bit of a disconnect that they wouldn't be trading quite as strong, and they obviously trade at much, much lower valuations. And we think there's going to be a catch up here, and we think it'll be driven partly by the very high shareholder returns by some of these smallest E&P natural gas companies or natural gas exposed companies, and then also from the services companies that should benefit tremendously as we go from this narrative of a perpetually falling rig count and perpetually improving well productivity narrative to a likely situation, which we're already starting to see play out, of a slowly rising rig count and falling well productivity. Again, the jury is out on the falling well productivity side. We understand that this is a quite aggressive stance that we're taking, that incremental rigs will experience lower well productivity, and that the overall industry may experience this going forward over the next few years. Even if we're wrong, we still think the rig count ends up higher. We think that day rates for these rigs end up higher, and we think that some of these rig stocks, particularly ones that are very rapidly paying off debt and trade at a large discount to their peers and to replacement cost, should do particularly well. And so we're really excited about this. We're happy to share it. And again, none of this is an offer, solicitation, or recommendation. The thought on sharing this is that we put together a webinar for our clients and friends and got a lot of good feedback and a lot of good questions, and we thought we would make this open to the broader public. Bison is only open to investment by accredited investors, so that's the general audience expected for this. And for anyone else, we're happy to help provide some education about the space. And we're not looking to make any sort of recommendations or solicitations or anything along those lines. So thank you very much for your time. Really appreciate it. Look forward to getting more feedback, more thoughts. And again, we're just so excited about this move towards modular LNG export facility construction, this move from 10-year type facilities to 30-month type facilities, the speed up in the building of these facilities along with the permitting and funding of them, and then also this inventory constraint that we described, where some of the largest incremental dry gas producers are looking for a much higher price than the current price and the current forward curve in order to speed up drilling and start growing again. Thank you again for your time. Take care.